sequence of events in which I lost everything and ended up $26 million in debt. So that ended my multifamily career. But I rebuilt myself through American Homeowner Preservation, AHP, which started out as a nonprofit to help families at risk of foreclosure stay in their homes. We started this in 2007 and 8. I used my experience from when I had when I was overwhelmed with debt, and I was able to use that experience with families across America, millions of families who were now struggling with unaffordable debt. And I was able to use that experience to devise strategies that were helpful to them. We started out as a nonprofit, but we eventually became a for-profit and started buying the mortgages. And that's where we really had the most success, both in terms of company profitability, but also in terms of achieving our social mission. We could buy these loans at big discounts from banks and hedge funds and in pools, and then we would share some of those discounts with the families. And we were able to achieve some and have been some great results over the last decade. We've purchased more than 10,000 distressed mortgages across the country. And we've also morphed into a couple of other businesses. We still buy mortgages, but we're also a national servicer, AHP Servicing. We service across the country, both for loans owned by AHP and loans owned by third parties. And we recently started, or last year started another platform called Pre-REO, where we are able to serve as a platform for hedge funds and eventually banks who want to sell their distressed mortgages to local investors who can simply buy them one-offs, one by one. And many a times we're selling to a real estate investor, especially in today's market where there's so few REOs. Many a times it's attractive to buy a pre-REO, which is a distressed mortgage earlier in the cycle, and typically at a much greater discount than what they could buy an REO for. So that's what we've been up to, and I think with what we anticipate to be a significant market disruption in the next 6 to 12 to 24 months, everything we do today is kind of geared up for that.
Okay, very good. Thanks for that introduction. A lot of our listeners still are in the commercial field, right? A lot of them are multifamily investors, but also in retail offices and so on. But I think it's very valuable to hear from your end on the single family side how things are going, right? Because obviously multifamily, particularly in the B and C class space, where a lot of private investors are investing in, it's not operating in a vacuum, mm-hmm. Right? Whatever happens in the single family world has a direct impact on multifamily too, particularly B and C class properties. And that's only the case when it comes to rent increases. Obviously, with single family homes, as we know now, with COVID-19 having that massive impact with property values jumping anywhere from 10% to 20, 30%, sometimes even more in certain markets. And that makes affordability obviously a big issue, which pushes more people into the rental market, which certainly short term has a positive impact on the multifamily space, particularly in the B and C class space. But I wanted to get a sense from you how you see that, what is happening in the single family world, what has happened over the last year since COVID-19 hit, and how also from an investor perspective, what the impact was for people that invested directly in single family homes, as well as invested in notes that obviously you're also offering investors a platform to invest in these notes.
Yeah, I appreciate you sharing that, Anton. We're powered by crowdfunding. So actually investors can come to our site, ahpservicing.com, and invest in a fund that invests in distressed mortgages. And we've been crowdfunding since 2013. This is our sixth fund. We did four 506C funds, which are funds which you can crowdfund. You can generally solicit but you can only take money from accredited investors. So that was the first 4 funds. In 2016, we did our first Regulation A+ offering, which allows us to generally solicit, but also accept investments from accredited and non-accredited investors. And that was a big turning point for us in terms of accessibility to just almost anyone can invest. And one of the things we did was we lowered our minimum investment, which was previously $10,000. We lowered it to $100. And so for $100, anyone can invest online. They can do it in a few minutes. And that was it was part marketing, because it was, wow, you can invest for only $100. But also, I think it gave a really low entry point, a really easy entry point for investors to participate. And we literally had one investor who put in $100, and like 3 or 4 months later, they put in $1 million. I think the first 100 was just, okay, let me see how this thing works. And it worked. And so they put in $1 million. So there is I mean, people say crowdfunding, how much money can you raise? We've raised almost $100 million online through crowdfunding. So it's been really helpful. Now, but we own tens of millions of dollars in loans when COVID hit. And I'll tell you, I was very concerned, both loans and some REOs. And I was thinking, oh, this is going to be really bad for our book. We're going to, there's going to be some value adjustments. And I was thinking it was going to be value adjustments going down. What's happened, as you alluded to, has been the complete opposite. We started seeing it last summer, where we had our first one. We had actually foreclosed on a home, and I'll just give it an example, in Akron, Ohio. And at that time, we had an agent go out there, and I believe they think that, hey, if you do a little bit of work, we can probably get this sold for 80 to 90,000. And but because of COVID, we were not able to get the deed until July. And so now we were able to get the deed. We could finally put the property on the market. And this is the sheriff, because the sheriff's office, they closed. And so we couldn't even get the deed from the sheriff for all this for months. But now we put it on the market. We send the agent out there and say, hey, let's get it listed. What do you think you can sell it for? He said, probably 120. So it went almost a 25% increase in just several months. And we put it on the market at 120. And again, this is last summer. Multiple offers, and we had one offer which I think was 128, so 8,000 over asking. And they said, hey, there was some kind of clause in there that if there's any other offers, we'll match them up to an additional $5,000. So that's the buyer we went with, and that has only escalated. I mean, everyone hears the stories now. We had one it wasn't ours. I wish it was. One in California that sold for $1 million over asking price. And you hear these stories that just across the country, like you said, 10, 20, 30% appreciation in many times less than a year. And that has been great for our book. So all these assets that I was concerned about in COVID, it's almost now great. Some of them were not resolved before COVID, because now we're, to the extent they're getting resolved, whether it's an REO being sold, or we get a deed in lieu from a family and we're selling that property, or we are doing a modification of a home, of a loan, and now selling that loan back into the market after it's performed for 6 or 12 months. In all cases, the prices today are significantly better than COVID, and that's been very, very good for AHP, for our funds, as well as I think just a lot of investors, anyone who was sitting on assets when COVID hit and was able to make it through those first 2 months, I think by and large are doing pretty well today. But that all said, I get concerned that, with all this wild appreciation, we've seen this before. I mean, I've seen it a few times, and I've been in real estate since 1990. And, usually these wild up, there's a site, this is all cyclical, and at some point, it goes up, 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 up. And the more it goes up, the greater the fall. And I really think there's going to be some correction coming up. And I think that will, as always, the distress typically creates the biggest opportunities for investors, whether it's multifamily or whether it's notes or whether it's single families. And I think that's coming. And it was obviously the end of the upcycle when COVID hit. And I thought that was going to be the trigger for it to go down. Now it's gone up, but there's going to be another side to this.
Yeah, it's really crazy, right? Also on the multifamily side, we we already thought that in 18, 19, that we really are hitting the plateau, right? And was really entered into 2020 with the expectation that it really cools off. Then and COVID-19 hit, everyone was scared, particularly in March of 2020. A lot of lenders exited, particularly on the bridge side, CMBS side. And then things improved very quickly. Obviously, the forbearances that the agencies were granting and other lenders, eviction restrictions and all that, combined with stimulus money that was aggressively pushed out, it just helped to alleviate that situation in the multifamily world. We obviously, hospitality and retail was a very different story, and is still struggling. Hopefully, comes just out of the out from the bottom now. So I think what you're telling us here is very similar also on the multifamily side, where you mentioned for your portfolio, for investors, and I think also all the various lenders, it was really very helpful with all these appreciations, right? You mentioned is not much of REO anywhere on books, which is not really a surprise, right? When you have all these appreciations. So if someone is in a house that they cannot afford in a typical market, you have to foreclose, right? Because they cannot sell and they cannot service that debt. So it needs to be foreclosed. But now, instead of having to foreclose, the owner just sells that property for, and very often even makes a profit. And I think we see the same thing really on the multifamily side. We have seen a lot of properties that have been mismanaged. The sponsors and operators do really have not done a great job, but because the appreciation in rents and then NOI and the contraction in cap rates, they were still able to sell these properties at the profit for their investors, right? So I think we have a very similar situation on the multifamily side as you see on the single family side, and it's only a concern of what is going to happen going forward, right? Because we have extremely low cap rates. Why can cap rates go lower? We have inflation pressure, which will have an impact on the longer end of the yield curve, which then has an impact on borrowing cost, which then has an impact also on the cap rates, right? At some point, you cannot contract cap rates when your 10-year treasury moves up. So there is only a similar concern on the multifamily side. The question is, when is it going to turn, right? Right now, similar to what you see on the single family side, the interest in multifamily by investors is just through the roof, right? Everyone wants to invest in multifamily. So there is such a high demand, which pushes, again, cap rates even lower. And you have more and more people that are investing in multifamily. So do you see the same thing on the single family side with investors still rushing into single family homes too?
Investors and home buyers, I mean, everybody's caught, is very enthusiastic. The low interest rates make it affordable. I mean, we have an origination arm, HP Mortgage Direct, and we are seeing situations where we just did one recently where the tenant purchased the home where she was renting from the landlord, and her rental rate was $1,100, and her all-in payment, principal, interest, taxes, insurance, and mortgage insurance was $455. So she cut her payment, her housing costs by more than half, and that was just dramatic. So when people see those types of numbers, hey, it's cheaper to buy than to rent. It makes financial sense to do so. Now, the unfortunate part is the reason they're buying their payments are so cheap is because the rates are so cheap. It makes them less sensitive to the fact that, hey, this price is historically high, what you're paying for the home. But if they can afford it, it makes sense. And these are typically buying today at fixed rates, so it'll keep their housing costs low. But that is is continuing to push these up, and it is a little bit concerning now. Concerning, and also, there's going to be an opportunity, but it also, what happens, and what I anticipate happen is today, like you said, if a property owner gets into trouble, they can oftentimes sell and walk away with some money in their pocket, so they're happy. But lenders today, if a homeowner isn't willing to sell, some homeowners, if their income was disrupted by COVID, then there's foreclosure moratoriums put in place for them, which was the right thing to do. But then there's certainly some people in there who weren't impacted by COVID, but are not paying their mortgage because they can do it. I think there will be once all these foreclosure moratoriums lift, we'll see which families can get under some longer term modification or something to stay in their home, and which ones aren't and end up having to sell. Having to get foreclosed upon. Now that will create some more REO inventory. Once that supply increases, it's got to kind of temper this appreciation and maybe even trigger a downturn in all likelihood. And what happens, all these people that bought the homes kind of today at what may be the height of the market, fast forward a year or two, and now property values are dropping, and they may be able to make their payments. They may be making their payments, but all of a sudden they owe 20 or 30% more. The house is worth, they bought it for 200 and now it's only worth 140 or 150, and they owe 190. They may be saying, hey, just like people did in 2008, 9, 10, 11, 12, where they were saying, why should we pay on a house that we owe, 20% more than it's worth? And then people that even can pay default, and that kind of adds to the inventory, adds to the foreclosures, and kind of helps fuel the downturn. So there is going to be a turning point to this. No one knows exactly when, but once it happens, since we've appreciated so high, there is high likelihood that it will be a severe downturn.
Yeah. It's only when we look at the borrowing costs today, right? It's really a question of where we are going to be in a year from now. I personally feel that the 10-year Treasury will be above the 2% mark in the near future. Early in the year, I predicted it will hit the 150 when we were at 110, and a month later we were already at 150. Now we were at 170 plus for a brief period. Now we are down at around 160 mark. But I think the inflationary pressure is just very, very strong there, right? And that is only also the fear on the multifamily as well as single family side. Once these borrowing costs move up, investors just cannot pay these debt services once these rates move up. So they have to offer less for these investment properties, right? So obviously one side is our actual homeowners that may or may still be able to afford it, but at some point it limits them, and then they have to offer less for a new home. And then you have all the investors that obviously run the numbers, and once the numbers do not make sense, they cannot pay what they would have been willing to pay before. So one question I have there on the single family side, I think FHA has come out with some new rules when it comes to investment properties, single family investment properties, where I think the rates have increased, the qualifications have also been tightened. So have you seen already there a little bit of a more difficulty for investors to get reasonable financing terms on investment properties?
Actually, I've not seen that yet. Even if FHA, FHA tightening the requirements, there's so much capital sloshing around in the economy right now. There's plenty of lenders out there who are offering options for investors. So I think the capital is still, if an investor wants to buy a property, they can usually find the capital. Maybe not FHA, to your point, but they'll find it. There's plenty of sources. Yeah, there's plenty of sources. Yeah. So that's maybe a prudent move on FHA's part. I mean, anticipating what we've discussed is, hey, we need to, I mean, investors are going to have the same issue, and maybe even more so when they have a single family and they, property value drops, so they owe, 180, 190 on a home that's now worth 150 and dropping. That's a reckoning. They're going to say, hey, and then it goes vacant or something like that. Are they going to walk away from this? Or what are they going to do? Do a short sale? What are the solutions to that? And with a business owner, or an investment property owner, it's typically, they're making decisions based on the numbers. Homeowners are often, also making decisions based on emotion. I want to stay in the home, my kids are there and stuff like that, which is understandable. But investors, it's going to be the numbers, and it's tough to justify, when you're severely underwater. We saw it last time. A lot of people just walked away. Multifamily too, and it just doesn't make sense. And from a business perspective, so we'll see how this one fares. It'll be interesting to have this conversation in in a year and 2 years, and kind of tie back to what we're talking about today. And people, I mean, my expectation, we could have the same conversation somewhere between a year and 2 years, and we're going to be looking back at this date, April 15th, 2021, and we're going to say, what was everyone thinking? They're paying prices that are just ridiculously high, and it just didn't make sense. And people forget. I mean, we've had this environment before, 2008, and every time it gets like this, people say, well, this time is different because ... whatever the reason, and it's never different. There's always a cycle. There's always a downturn that follows the significant upturn.
Yeah. Certainly a very good point, right? As we have seen on the single family side in 2006, 2007, everyone was investing, right? Mm-hmm. Obviously, money was readily available, and that helped. So now, forward to today, money is readily available, as you mentioned, right, to finance some of these acquisitions, particularly on the investment side, right? And so we also see that on the multifamily side, I would say there are very good operators, right, that are doing it as a true business. They have an understanding of the risks and know operations well. But we certainly see plenty of people that are entering into multifamily that have been in a very good spot because the market helped them. Rescue them in previous deals that they have done over the last 5 to 7 years. They really have won and made good money for themselves and their investors, not because of their operational performance, but because the market was essentially helping them. And I think that brought in more investors into the marketplace with the view, oh, multifamily is easy. Right, you make money here. That's all the returns that you can generate. And I think what we see is there are a lot of operators that are not really, that should not be in multifamily at all. And I predict that we will see some opportunities there because these operators will not be able to perform once the market turns, right? Once rent again not just flatten but potentially go down, but also operating costs goes up, right? Even if rents stay the same, inflationary pressure is also on the expense side, and a lot of them will not be able to operate at the profit that they predicted. And you just need some cap rates going up, and then suddenly they realize, as you mentioned, oh, now I don't really have any value in that property. So what I do now, I think it's not worthwhile to spend our time here because I've, as a GP, as a general partner sponsor, I spend all my time here, and I likely will not see any money anymore still. And that's when typically the tide turns. So I completely agree with you. What we have seen back in 2005, 6, and 7 with that frenzy, we really have a very similar frenzy today, right? It's and it's it doesn't mean that one should not invest, right? If it's smart investing, but there are certainly a lot of players that are just jumping in and hope for the best. And we see a lot of operators and sponsors that haven't bought a property for more than a year that are very experienced. So you always have to wonder, why is it that the ones that are really doing their due diligence, they're vertically integrated, they know what they're doing, why are they not buying while newcomers are just gobbling up one property after another?
It's true. You made a comment earlier, which I think is very accurate, that even today, because of the appreciation, a weaker operator can look like a big success story. But remember, I think there's another part of that, which is in a downturn, in a bad market, even a strong operator can look bad. So I think it goes both ways. So right now, everybody looks good. Anybody was holding assets and was able to make it through COVID. Real estate assets are generally doing very, very well. And I think, but now you hold too long. I hate to say it, but this is these are almost like these market frenzies make real estate seem like a pyramid scheme. Everybody makes money except the last guy to buy, the last person to buy, and they are the ones that the market turns. They're holding the property, and all those gains are given back, and the pyramid collapses. So I mean, for anyone out there buying, I really have to say, and I think Anthony made a good point. A lot of experienced buyers are on the sidelines right now, or they're probably sellers if they have stuff to sell, because we've got to be right near the top of that pyramid.
Yeah, certainly very close. And the question is, how much upside is still there, other than just the speculative element to it, right?
Yeah.
So will be very interesting to see what's happening over the next year or two. So we certainly should follow up in a year or two from now and see how things have evolved. And who knows, maybe we are still in that frenzy. So somehow it stretches out more and more, right? Because of additional stimulus money and or forbearances that are being further pushed out. Who knows, right? But as you said, at some point it needs it needs to adjust, right? Because there is only so much that one can stretch, and as we have seen with the stock market, it can go on for quite some time. There, it's the same frenzy, right? When everyone and their friend is investing in GameStop and everything else.
That was on the tip of my tongue when you said it.
Yeah.
So yeah, that's it's not based on like the underlying stock. It's all speculation at that point.
That's right.
That is,
yes.
Short term, people make a lot of money, and that's and good for them. But somebody bought it at that top price and didn't do so well. So
yeah, that's right. So hopefully no one who is listening will be at the top of the mountain on the buying side, right? Because it's only, and if someone is, then hopefully they have enough equity in the property and enough cash reserves that they can run it through 2 to 3 years of a tough situation, right? And I think that is, when we look back to 2008, 9, and 10, even the ones that had a cash flowing property, if they had to refinance right at that point, they still lost the property, right? Because the value, as you mentioned, right, once the value drops to, you mentioned the single family property of 200,000, now 150. If you have to refinance right at that point, even though it was cash flowing with your previous mortgage to service that debt, no one is willing to refinance it for the previous loan. So you need to bring equity to the table. And if you don't have that, well, you essentially have to walk away. And the same thing happened also on the multifamily side, where if someone was caught right there to refinance during that tough period where values dropped by around 20%, right on the multifamily side during a relatively short period, but it doesn't matter whether it just drops by 20% for 1 year and then recovers after that. If you have to refinance right at that point, it doesn't matter, right?
Yeah, exactly.
A lender doesn't say, well, let's wait for another year and see where the values are, right? So I think the message there probably is only on the multifamily side. Make sure that you always have a cushion of 2 to 3 years so that you are not forced to refinance. And I do not know how it is on the single family side, where you have a similar situation where some investors are more into short-term loans, where the risk obviously is much higher if you are forced to find another loan if the market turns.
Yeah, it's the same thing. I mean, anybody, especially for investors who are taking out fix and flip or bridge type financing for a year or two, hoping to add value and then resell. They get caught midway. Then when the market turns, that's it is very difficult to refinance. They have to bring cash in. The market value's dropped. That's why every time the market turns, there's always some big construction in big buildings that are half done, and they're left half done because everyone walks away, and the lender gets to figure out what to do with it.
Absolutely, right. And we already have seen it, right? I have some friends that are in the fix and flip world. And there was already a phase in 2019 when it happened, where particularly in high value markets along the coast in California, where they were caught with buying a property too high, thought that they can rehab it and sell it, and then someone realized, there is not as much demand as it was just a few months earlier. And they've, as you know, right, once you have these $1 million+ properties, the carrying costs with hard money loans are just through the roofs. And a lot of them, they already back then had to sell at the loss just to get out of it. And that was just a slight dip for a brief period of time when the markets kind of cooled down. So I would say that's kind of just a sign. Once the market really turns, then things start unraveling very quickly. So
yeah, it could be weeks or months. I mean, it's not very long. Yeah, and you don't want to be caught. I mean, right now we're trying to sell everything we can, and I think that's do that because it does. You're right. It happens very fast, and no one's saying, hey, it happened. It's just suddenly people start hearing, hey, stuff isn't selling. There's more supply on the market, or whatever the components. Interest rates rise, and we start seeing. And then there's something like COVID. It didn't happen this time, but usually there's like one event, which then the news is all talking about. Hey, the market's crashing, and so that's going to happen. I mean, it just happens. It happens every 1990, 2000, 2008. There's multiple times this has happened over our lifetimes, and it will continue to happen. People should never be surprised, but they always seem to be.
Yeah, definitely. So obviously there will be plenty of opportunity there, right? I think it's more important than ever to invest smart, right? So that you have that cushion in whatever you're investing, that either you're on the beneficial end if things go sideways or go down, or you have enough of a cushion that you can ride out the storm, right? So I think these are the two strategies, and I think it's only with your programs for investors you're offering some alternatives there. Before we end, I was just wondering, since we have a lot of investors and sponsors that are also doing 506Bs, 506Cs. Some of them are also considering the larger ones, the Reg As.
Sure.
So maybe you just can give kind of a picture of how easy it was for you to transition from a 506C to a Reg A offering. Obviously, it's costlier, it's more time consuming, but how was your experience there to start out moving over from the 506C side?
Yeah, so 506Cs are very, I mean, in relative to Regulation A plus are very easy. You can set them up. You don't have to wait for the SEC to review everything. You can just if you comply with the guidelines, you can get a site up and an offering up fairly promptly. Regulation A plus, you need to put together the offering statement package and submit it to the SEC. And then we went back and forth several times. I think our first one took 7-8 months to get it qualified by the SEC, so we could finally start raising capital. And the second one took almost about the same amount of time. We're working on a third one now that we've already submitted to the SEC a couple months ago. And so it is a back and forth process. It costs a lot more money in legal fees. I mean, I think the 506C, I forget the numbers, but it's in the $10,000-ish range, whereas the Regulation A plus is closer to the $75,000 range to get it up. But Regulation A plus, I mean, the huge advantage is that you can accept money from non-accredited investors, which still most non-accredited investors have limited investment options. So once there's a viable Reg A offering up, there's definitely interest, or that's certainly what we found. I mean, both of our last two funds have had more than 1,000 investors each, and that has it makes it. I mean, when we had a 506C, we'd be kind of marketing the fund. I remember talking about it on a local radio show, and we had an investor walk into our office with $100,000 check, and hey, I want to invest. I heard about it. Sounds great. But then we discovered he was non-accredited, and we couldn't take the check. We had to, sorry, we can't take it. And that was, so there's definitely, the marketing that you do for 506C will hit non-accredited investors, will attract non-accredited investors, and you have to turn them away. Whereas Regulation A plus, there's limits on how much they can invest, but still they can invest. And that, I think, makes your offering much more scalable. So, anything we do in the future is Regulation A plus. Our goal is to take the next step to actually do a public offering, listed on the exchange. That's fast forward a few more years, but that's where we want to eventually get. But that's our transition. We first started out with just a traditional, in 2011, traditional hedge fund where we had to print out I forgot what they were called, our prospectus. We had to number them when we handed them out. And that was, we couldn't market. We couldn't, if I talked to someone in the media, I couldn't tell them what we paid our investors. But that all changed with crowdfunding in 2013. I think it's a lot of opportunity. I'd encourage investors to go the crowdfunding route. Definitely.
Yeah, very good. So the actual crowdfunding side, do you have your own platform, or do you use a third-party platform that manages it all for you? Because that's obviously is a challenge when you have investors that come in with $100, $1,000. That's the 506C managing investors is like a walk in the park in comparison. Right?
So regular. Yeah, so here's my perspective, which is probably an outlier, but I think it's served us well over the long term. When you go to a third-party platform and they handle all the back end for you, very attractive. But the downside to that is they own those investor relationships. When someone goes to Realty Mogul or Patch of Land or any of the other sites, that they're going there, and they identify, hey, I've invested in this opportunity on Realty Mogul, even though it was your fund or your apartment complex that they were offering. And so when you do it on your own and you build up a brand as XYZ apartment investment fund, and you build up that brand over time, you're developing an email list and a group of investors who identify with XYZ apartment investing fund. And I think that's a huge value. So if you're looking to do this long-term, raise money, then we did it that route. And it was slower going at the beginning because we couldn't plug into one of the big platforms' existing network of investors. So we had to build up our own investor network. So I'd be on podcasts like today. I'd be on radio shows. I'd be on blogs, speaking at conferences. But all of it was to kind of build our investor base, build awareness of AHP, and as a result, build our investor base. And we kind of own those relationships. We put up webinars, which we do periodically, pretty frequently, and give investors updates. And that's our audience. So I think that's huge value. If you're looking to this long term, I think that's and do multiple raises. I think there's a lot of value in doing it on your own. And there are plenty of plug-in services that you can use kind of for your back end. So even though they're going to, in our case, an AHP site or AHP servicing today, then and investing on the back end, we're oftentimes levering different technology solutions or different service providers to process those funds. But that is, I mean, it's like Amazon. I wrote a book called Burn Zones about, all the building up that portfolio of 4,000 units and then losing it all. And I sell it directly through my own site, and I sell it through Amazon. And the majority of the sales go through Amazon. And the problem with Amazon is they know that they own that customer relationship. I just get royalties, and I don't know who bought it. I'd love to have those book buyers in my database so I can build relationships with them. So same thing. A lot of value. If you're doing this long term, I definitely encourage you to have your own portal and build up your own investor following.
Yeah, excellent point. Right, on your client, right, and on your customers rather than someone else. That's a really excellent recommendation. One more question on the Reg A Plus side, in terms of reporting and auditing from the SEC side. Have you had some issues there, or
no issues?
Yeah.
No issues. It's just it's an additional layer of work, is what it is. I mean, not in a bad way. We have to have audited financials, so you have to get your financials audited each year, and then you need to file the audits, and you need to file other filings with the SEC on a regular basis. But it's fairly easy to map out, like they're due on such and such a date, and you need to get them done. And that is so yes, there's more requirements, but I don't think it's I don't think they're extraordinary, and they're predictable. So it's manageable. If you're doing this at scale for long term, I think it makes sense. I mean, our goal is to use our experience, having audited financials, public, reporting through EDGAR, through the SEC site, as we keep growing into larger and larger funds, and eventually, hopefully, getting listed on exchange. That's all good experience, because we're going to need to do that on an increasingly robust level.
Sure, yeah, and obviously having all the financials also helps the confidence by investors, right?
Absolutely.
So they can trust it. Obviously, there are always cases that the auditors miss something, but it's definitely an additional layer of protection. There is no doubt about that. So, George, thanks again for adding so much value to our listeners today. How can they reach you? Obviously, you have different investment platforms from AHP as well as pre-REO. So why don't you give us your contact details so that the listeners can reach you?
Yeah, absolutely. You can go learn about our AHP servicing, our crowdfunding opportunity. You can go to ahpservicing.com. If you're looking to buy a distressed mortgage or learn more, we also sell REOs. You can go to prereo.com, and on there's plenty of contact information if you want to reach me or anyone on our team. So I encourage and welcome any inquiries, feedback, thoughts. Please reach out. We'd love to talk.
All right, great. Thanks again for coming on and sharing all your knowledge with us.
I appreciate that, Anton. Thanks for having me on.
Yeah, thank you.
I'll talk to you later. Bye.